All righty. We are going to wrap up our discussion about cost of equity by now talking about how a company might go about figuring out their cost of equity. The example we've given so far is you inside of a project where you have your free cash flows forecasts out. You've shared that with the investor, and the two of you have sort of negotiated on share of the company and amount of money. And we've derived basically from that the cost of equity. Well, here's the deal for a publicly traded company. First of all, the publicly traded company oftentimes has its own cash. It has money in reserve and so forth. So it doesn't want to have to go out and raise money in order to estimate a cost of equity for its projects. It just wants to know what the cost of equity would be if it did raise it. In addition to that, publicly traded companies are just not in the habit of going around to all of their individual stockholders anytime they want to issue new stock and basically giving them pro forma projections of free cash flows to equity or whatever else. They just don't do that. They certainly talk to them about what they think prospects in the future are and all of that sort of stuff, but it's not in their best interest, particularly when you consider that then competitors can get their hands on that information. And so given that investors and the company aren't sharing this information, they have to rely less on trying to figure out a value and then solve for the cost of equity, and they instead have to have some other theoretical way for estimating the cost of equity. So, how do they do that? Well, according to theory, if we assume that investors are buyers of an investment from sellers of an investment, then the buyers desire to maximize their return on investment, and they do this by purchasing at the lowest price possible. So if you think about it, the investment's going to have the same amount of cash flows no matter what. And so the only way you can change your rate of return is to either pay less for those, and that raises your rate of return, so you're getting those cash flows with less money invested, or you pay more for those, and so your return goes down because again you're getting the same cash flows, but you had to put more money in to get those cash flows. The seller, on the other hand, desires to maximize their return on investment, and so they seek to do this by selling the investment at the highest price possible. Therefore, the agreed upon price reflects amount that both the buyer and the seller believe is fair. It may not be their best price that they hope to get, but it's an acceptable price, otherwise there wouldn't be a transaction. And that agreed price must imply some fair return, some return that's maybe a little lower than what the buyer would like to get, but in the acceptable range, a little higher than what the seller would like to give up, but in the acceptable range, and so they found an overlap. So in that sense, the fair return on investment to a buyer of an investment should reflect the risk that they take from taking on the investment, and that's just theory. It says that aside from looking at other comparable investments and everything else, that the buyer expects a return that is commensurate with the amount of risk that he's taking. And again, how do they know that? They go look at other similar type investments and what kinds of returns are being earned on those. And if it's got similar risk to this, then it would be reasonable to think that you might want to have this same thing. So here's where the real challenge comes. As a buyer, you might look at an investment and say, well, that looks really risky. And so let's just say that I think that the earnings per share are $2.50, and they're going to go on at that rate forever. So it's a $2.50 perpetuity. And I think that the fair discount rate on that is 12.5% because they're a little risky. So I would discount that $12.50 back to present value of $20. That's just $2.50 divided by 12.5% equals $20, right? So that's the present value of perpetuity. The seller, on the other hand, would say, it's not that risky. probably only need a 10% rate of return. Again, same earnings per share of $2.50. They divide it by 10% and say the fair price is $25. So buyer's willing to pay 20, seller thinks it's worth 25. You either have to find some agreed upon price in the middle, or you get no deal. So what theory says is that we can't just look at the total risk. We can't look at the variability overall in an investment without thinking about the other investments that are in the portfolio with it. And the reason for this is there's this concept of diversification. And so while this particular investment might do very well next year, or let's say it might do very poorly next year, other investments in your portfolio might do very well next year. And to the extent that when one does well, the other does poorly, and vice versa, those two offset each other so that the overall riskiness of your investments is lower, right? So one offsets the other in good years and vice versa in bad years, and you get this result that's a lot smoother. And so what the theory says is that since an investor can diversify, they should diversify, and therefore they should only get rewarded for the amount of risk that they can't diversify away. Okay? And so kind of think about it like this. It's a lot to take in, but let's think about it this way. Let's say you're an investor in Yahoo stock. Now, quick thing here, when we're talking about risk now to an investor, remember that they don't necessarily have any guarantee of dividend payments. And so the thing that they're more worried about is how much is the stock price going to jump around? Or more relative to them, on a day-to-day basis, how much uncertainty is there of what their daily returns are going to be? So if we just took as the return for a stock, we calculated, we went out and looked at what its price was today, and we divide that by its price yesterday, and we subtract 1, we get the daily return on the stock. So let's say the price was $25 today, and yesterday it was $24, right? So 25 over, well, I can't do that math. Sorry. So 25 over 20, let's just say. That'd be 1.2 minus 1. So 20%, so the price would have gone up 20% in the day. Obviously, that's a lot. But anyway, if we did that, we would see that sometimes the returns are positive. They're greater than 0. And sometimes they're negative. And so the real risk is that they're negative, meaning that the stock price went down from yesterday to today. And that happens. And we could see on any given day kind of how wide that range is. And so here we're looking at Yahoo. And with Yahoo, we can see in this picture sort of day to day what's happening to the returns. They go up, they go down, kind of jump around. And if we were to put that into a distribution where you kind of have the likelihood of the returns and the shape of the returns, you can see that it's relatively unlikely you're going to see something much smaller than 6% loss. You might see some 8% gains, centered kind of around 0. In fact, if you look, the mean is 0.08% a day. All right. Now remember, that's a per day percentage, but this isn't 8%. This is 0.08%. You got a standard deviation of about 1.9%, and the biggest loss you saw was 6.2%. Okay, so that's sort of your sense for that stock of how risky it is. So you might look and say, okay, well, based on that, I'm kind of thinking, what do I want to pay for Yahoo stock, and what's it worth? Well, then you go look at Apple stock. Do the exact same thing. If you kind of jump back between them, I put the axes on the same basis so you can say that the Apple stock's a little less risky. It also doesn't move around the same way, right? There's the Yahoo, there's the Apple, and so you don't see the spikes happening on the same days, for example. The portfolio return is minus 0.02%, so it actually lost money on average daily basis. It has a standard deviation of about 1.5%. Yahoo was 1.9, so it's a little less risky. But it has a max loss of 6.5%. It's a little bit bigger than the max loss from Yahoo. All right. Again, if we look at these on distribution, not that big a difference between them. Not huge, okay? But what if we put them together? So we put them together, we get something that's a lot smaller than either one in terms of its variability here, right? Quite a bit less variable than either one. When we look at that sort of spread, we see, yeah, there's stuff kind of out there, but we get a portfolio return of 0.03%, so somewhere in the middle of the two. We get a standard deviation that's less than the standard deviation of both of them, right? One was 1.9, the other's 1.5. We put them together, we get 1.43. And again, that's because on some days when one of them has got a high return, the other one had a low return, and they sort of wound up in the middle. And the worst day is a minus 5.2% overall, which is less than the worst day on any of the others. And so that's what happens because we've diversified them. All right? We've put the two of them together, and that's reduced their risk. Now, what happens if we were to put a whole bunch of them together? And here I've got an example where I've just combined 10 stocks together, the two plus some more. And when you put it all together, you get a mean of about 0%, so no average return. Standard deviation went from 1.43 down to 1.26. Max loss went from 5.2% to 4.4%. And so by adding more in, we've sort of further reduced the risk. Now, at the limit, you could add everything in. Problem is we don't know what everything is, right? We don't even, there are stocks out there that we just don't have the daily information on. But as an approximation for that, I went and grabbed the S&P 500. Standard & Poor 500 is the 500 largest cap stocks on the U.S. stock exchanges, so it has 500 stocks in it. There are thousands of stocks out there, but just looking at that, you can see that's quite a bit smaller as well. Quite a bit smaller. Again, its mean is 0. Standard deviation, by going that far, you go from 1.26 to 0.88. So remember, you started with Yahoo at 1.91, Apple at, I forget, 1.54, right? And by going to the S&P, you're at 0.88. So you've diversified away a lot. Your worst daily loss is 3.5%. So you went from having worst daily loss of 6.2% to 3.6%. So quite a bit less risky. And all you've done there is you've taken your money and spread it out among multiple stocks. And so that's this notion of diversification. So the idea is that the uncertainty and risk of loss in the portfolio gets smaller as more investments are added to the portfolio because the returns are not perfectly positively correlated. And all that means is that on days when one goes up, the other doesn't necessarily go up. On days when one goes down, the other doesn't necessarily go down. And particularly not by the same amounts. And so mathematically, the way this works is that the variance of a weighted average of 2 time series that are not perfectly positively correlated will always be less than the average of the 2 variances. Holds for a very large number of investments. So obviously we have 500 in the S&P, so it works for that. But you can get a lot of the benefits with a smaller pool of investments. So you saw that we got a lot of diversification just by going to 10 stocks from one. We got a little bit more by going from 10 to 500. Quite frankly, the typical sort of number most people think in terms of is 20 or 30 investments is probably a well-diversified portfolio and gets you most of the diversification. All right. So again, at the limit, you could put all possible investments, not just all stock, but all possible investments, art, cars, coins, right? Technically, you could put all those in as investments. You don't have daily information on all of them, but assuming you had it, you could track it, and that would be the most diversified portfolio possible. So, the problem that we have basically is this. You have an investor who wants to buy a stock, but we don't know what portfolio that investor is going to put the stock in. It could just be that they're buying on its own, or it could be that they're putting it into this very diversified portfolio. And depending on which portfolio they're going to put it in, that very much changes how much risk the investor is going to take. And so what the theory says is, since it's the investor's option to diversify, and diversifying is generally a smart thing to do, that we shouldn't be compensating investors for risks that could have been diversified away just because they chose not to diversify them away. Okay, so that's kind of the starting point here. So we're no longer looking at two stocks, let's just say, and looking at their total risk. We're looking at how much of the risk is left that can't be diversified away. That's a little trickier issue. Okay, so to get to that, we have to start with some sort of a notion of what counts as diversified. Again, theory says the market portfolio is the most diversified portfolio, and so you might want to start with that. And so the idea would be that the risk in the market portfolio is due to factors that can't be diversified away. We call those systemic risks sometimes, or systematic risks. And so think of those as risks that aren't company specific. They have to do with other pieces of information or news coming into the market. And so the compensation that an investor gets, since they're only getting compensated for things that can't otherwise be diversified away, and those things that can't be diversified away are sources of systemic risk or systematic risk, then the investor must only be getting compensated for the systematic risk. So that's idea is something that we call the capital asset pricing theory. Now, I have in this slide that there's two approaches. We're only going to talk about one of those now. The other's a bit more advanced. But the idea behind the capital asset pricing model simply is that all systematic risk is reflected in the market portfolio. So if we look at the daily returns or monthly returns or whatever on the market portfolio that includes all assets, it only moves, those returns only happen because of systematic factors. And the only risk that an investor should be compensated for is risk that can't be diversified away, and therefore is this systematic risk, and therefore the risk premium that an investor is entitled to must be something that is tied to this systematic risk. Okay, and so essentially what it says is that the risk that a investor is entitled to, the return that investors are entitled to, is related to how much of the variability in their stock returns can be explained by variability in the market portfolio, meaning by systematic risk. And so a shortcut version of that is their return should be based on the risk that they have that is systematic risk as opposed to non-systematic risk. That's a lot to take in. It really simplifies down to a pretty simple formula. The return on the investment, in this case we're talking about stock return, is equal to the return on the risk-free investment, so usually that's a treasury bond, plus beta, which is just a measure of how much systematic risk your investment has, times what we call the risk premium. So the return on the market portfolio minus the risk-free rate. So the risk premium, think of that as how much return the market is willing to pay for each one beta or one unit of systematic risk. So the real key here is that your company might have a high degree of systematic risk, meaning that its returns, its stock returns move a lot, its stock price reacts a lot to systematic factors, or it could have a very low systematic risk, meaning that its stock returns don't move much at all based on systematic factors. And so rather than looking at its variability, we only look at the moves that are tied to systematic factors, and we want to know how sensitive your stock is to that. Here's how you might put that into action. So again, this is the information for the S&P 500, which we're using as our proxy or estimate for the market portfolio. Here is the Yahoo stock price. And what we did was we plotted the two prices against each other. I want to be clear what I mean by that. And so not the two prices, sorry, the returns. And so, for example, we might take the return for Yahoo of right around 6% on a particular date, and we would plot the Yahoo return, that's on this axis, right? So it's at 6%. On that same date, we're going to go grab the S&P return and plot it, and it's hard to tell there, but it's actually somewhere around, let's say, -2. All right, and so there's 6%. Remember, up, -2 back, and so that's a single dot. All right, and so at the end of the day, we've got one dot that is the intersection between where the return for Yahoo is on that day versus where the return for S&P is on that day, and we put a dot out there for each day, and so obviously, if one return is high when the other one's high, we'd expect a dot out here. If one return is low when the other one's low, we'd expect a dot out here. And in those two quadrants, if the Yahoo is high but the S&P is low, you wind up here. If the Yahoo is low but the S&P is high, you wind up out here. And so that's what we call a scatter plot. And then we would try to estimate a line through this scatter plot that best describes all of the dots. So it has to be a straight line that is the best fit for those dots. Now, it may not be a great fit. Some of the dots are not anywhere close to it. But we're not looking for a great fit. We're looking for the line that best fits, meaning that it explains most of what's going on with the dots of any straight line that you could put through there, okay? And so this isn't a stats class, not going to go into the regression analysis for this, but the math for these two basically comes back and says, oh, the slope of that line, which we would call beta, the slope of this line that goes through there is 1.3. And so we would say that the risk that the Yahoo stock has a sensitivity to systematic factors. So its return reacts to systematic shocks at 1.3 times the rate that the market does. And so it's riskier than the S&P 500 market that we've used. And so we've got to figure out a return that has got to be higher than what the S&P return is, because this is a riskier stock. So we would simply plug these numbers in. We'd go out and look at a treasury security. Usually you're going to use about a 5% treasury security rate here. We're going to look at a return on the market, and again, you might look at the last 5 to 6 years annual return on the market. And so we got a return of 1% for the risk-free rate, return on the market of 6%, a beta of 1.3, so it's just 1, which is the 1%, plus 1.3 times 6% minus 1%, or 5%, that's the market premium, risk premium. So it's 1.3 times 5, right? So that's 6.5 plus the 1 equals 7.5. And so we've just solved for basically the required return on that stock according to the CAPM. So we didn't have to know anything about future cash flows. We didn't have to know anything other than We saw how the stock price reacts to information compared to how the overall market portfolio reacts to information, and that's all we needed to get this. So it's a very different approach, kind of directly towards getting at this. Is it a great approach? Probably not great, probably not perfect, but remember our situation. We just don't have a whole lot of other information available to us about these public companies. And so this is, we're trying to do the best we can with limited information. Now, when we go through that process, what we may find is that once you control for the systematic risk, right, so you're only looking at what the risk is after diversification, you might both look at that and say, oh, fair return on my stock is about what we thought. So your buyer and your seller might actually agree. They might use this CAPM, calculate out, and come to some sort of an approximate agreement on the risk. Both of them at 10%. The earnings per share are published for companies, and so they agree on the $25. They shake hands and they have a deal. So the idea, one of the neat things about the capital asset pricing model is it doesn't need you to know what one investor thinks versus another. The information is all publicly available, and so as a result of that, we have a lot less discussion about what's the fair return. That doesn't mean that everybody buys and sells stocks based on that. It simply means that the discussions around, why is the stock this, or why is the stock price that, or can I get a better deal, this, that, or the other, those discussions become much more simplified, and there's a lot fewer moving parts once we can sort of agree on this theory. So that seems like such a simple way. Why don't we just use that for your project? Well, here's the deal for your project. In order for you to use that for your project, you would have to know the required return each day, right? Or maybe let's just say this. I'm saying it backwards. Sorry. In order to know this, you'd need to know your beta, okay, for your company or your project. And the only way you could know that beta is that you would have to have a history of stock prices and daily returns for your stock that you could then compare up against the S&P 500 or whatever your other proxy for market is, so that you could solve for that beta. And you don't have publicly traded stock. And so it's really difficult for you to do this. Now, in advanced classes, we'll talk a little bit more about ways that you might be able to sort of approximate this. But for now, the bottom line is that you just need to assume for your project, you can't really go through and do this capital asset pricing model approach. So that's why you're using a negotiated approach to estimate this, as opposed to a market approach to estimate your cost of equity. Anyway, hopefully I didn't stumble through that too much, and hopefully that's a useful contrast for you. Thank you.